So now we continue with beginner series 102, understanding CFDs. So what are CFDs? Contracts for difference. So contract for difference. What is the purpose of this asset? It's mainly speculative. For difference, you earn the difference between the buy and the sell price. So you buy a contract, you sell a contract, and you earn or lose the difference. But the contract is orientated or is based on a specific asset. This can be oil, this can be gold, this can be a currency, anything. What or where is it traded? Mainly over the counter. So there is a decentralized network of brokers, banks, and liquidity providers. So when you trade CFDs through your Forex broker, most likely you have your broker, but the CFD is not created by your broker. Your broker has different liquidity providers in the background. They provide the liquidity so you can buy and sell anytime in the product. And the broker decides if they really execute you or they will continue to send you to the B book. So there's B book and A book. And B book is you buy, I sell, we get matched. And the broker just executes nothing because they think that you as well as me will lose money. If we lose money, the broker earns money. When the broker decides to execute us on a real exchange, so really, for example, you buy euro dollar and I sell euro dollar, when we have the same amount, the broker can do nothing because one of us will lose money, one of us will earn money, but most likely we don't have the exact same amount we buy and sell, and then the broker can decide if he's gonna hedge this on the real market or not. If he's not hedging it and or in the sum, we lose more money, then the broker earns money. If we make money, then the broker, of course, loses money. But the structure behind CFDs is you have brokers, different brokers, and then you have most of the times liquidity providers in the background, and they are mainly kind of decentralized. I mean, each company, liquidity provider or broker is most of the time centralized, but in the combination, it's kind of a decentralized network. And these are the typical retail Forex MT4 or MetaTrader 4, MetaTrader 5 or prop firm contracts or products you trade on those. There is a higher conflict of interest with the broker because of the reasons I just explained. Yes, there are also brokers that execute real time. I mean, you don't really care if the broker is good, the spreads are low and the commissions are low, and you get your money when you earn money. Everything's fine. I mean, you don't have to care if it's A book, B book, and if you execute it. But as we've seen in the past time, in the prop firm space especially, if there's a big conflict of interest, maybe at some point the company is gonna die and you will not be able to withdraw the profits you made on that broker. So you will need to check for a broker with less conflict of interest. But you need to understand the product, and the product you trade, most brokers are CFDs, contracts for difference. What are the pros of CFDs? You have very low entry barriers and very high leverage. On the brokers, you can trade sometimes 0.01 or even 0.01 lot, so very small position size. Usually when you have a future contract, you have like a minimum size. There are major contracts and minor contracts, but there's a minimum size that is way higher than trading CFDs on those brokers. And you have very low margins, so you can start trading with like $10 in the account, and then you're able to trade with most assets or other products you're going to trade. This is not possible, but it is a pro of the asset. So if you want to have very small accounts, the entry barrier is very low. You have very low spreads with a good broker. There are brokers that offer very low spreads, even sometimes lower spreads than you would have in an official future contracts, for example, or future markets, but depends on the broker and also depends on how your broker acts, because sometimes they tell you, okay, the average spread on the platform is XYZ, and then you need to double check, is this really the spread or is the spread sometimes widening when you open a position? CFDs are very user-friendly, so you have an ecosystem. There are very easy to use platforms like MetaTrader, also TradingView, and it's very easy to buy or trade because you can just click buy and sell. When you trade futures or especially options, it's way more complex, and you need to know more for this than trading CFDs. And in CFDs, you have the ability to hedge in the same contract. What does this mean? We'll go deeper into that when we explain futures, but we explain it now shortly here. In a CFD, you can buy, for example, I'm trading gold, and then I buy one lot of gold. And then gold rises, and then I don't want to close my position, but I think gold's gonna correct a little bit or reverse. And then I can sell one lot gold. And then I have two open positions, and then I just have the gold market. There's like whatever the gold market's called, XAU. There are different types how the CFD is named. The underlying asset is gold. I'm trading gold market. I buy one lot. Don't want to close the position. I want to hedge myself. So I sell one lot. Or I can even sell two lots, and then I have like two open positions. One position is long, one position is short, and I can have this at the same time in the same market. When you trade futures, for example, it's not possible. When I buy one contract, and then I want to hedge myself, and I sell one contract, then my contract that is long is sold, and there's not a possibility to have in the same contract, one contract long, one contract short. Impossible there, but with CFDs you can do this. And you have micro lots, as I said at the beginning. So you have very, very fractional, very small shares or contracts you can choose. And that can be very good and useful for risk management, because if you want to do risk management in other asset classes, you need more capital and you have less flexibility. What are the negative sides of CFDs? They are mainly unregulated, or they are regulated in Cyprus or the Bahamas or any other tax-free countries, so there's way less regulation than in other assets. It's very untransparent, so there is no real volume data. You don't get real volume data like on a centralized stock exchange. When a stock is traded on a stock exchange, then you know how much volume is traded on that stock exchange. With CFDs, that's way more untransparent. So you don't have a real volume data. The volume is mainly based on ticks. So how often did the price on that day change the price? So when there was a price change, it's one tick. But even there's no change in price, there can also be traded several contracts. We will go through market mechanics in series 200 and deeper into that, but you don't have real volume data with CFDs. And there is a possibility of high spreads or overnight swaps. So swaps are like the interest difference between two currencies. One currency has a higher interest rate, the other currency has a lower interest rate. So you will need to pay an interest difference, or you get an interest difference depending on what asset or what currency pair you are long or short. So you need to pay or get swap, but most of the times you need to pay swap, and you have the possibility of high spreads. For example, that the spreads are just way higher than you would have it in future markets or other markets or regulated centralized stock exchanges where you trade. And even a lot of brokers just raises spreads and you don't even know. So there is a spread of 1 pip the whole time. And then when you buy or sell market, exactly in that second, the spread rises. So the broker earns more money. And you have higher chances of requoting, spread widening, the things I just explained, and requoting, that you don't get executed to the price where you are executed because the liquidity provider says there was no liquidity, so you got a worse execution price. This happens also a lot of times and most people don't notice. Those are the cons. And what order types you have in CFDs? You have buy market, so you buy at the best price that is possible there, but this is decided by either the broker or the liquidity provider behind the broker. What is the best price now you can buy to? It's also called the ask. Then you can sell market. This is sell the best, what's the best price now in the second you can sell to. It's also called the bid. And you can just manually close depending on if you have a long position or a short position, you get the best bid or the best ask price. What are the CFD exit orders? You have a take profit. So you close a position at a specific price. Doesn't matter if it's long or short, it's a take profit, but it depends on if it's a sell or a buy in this case. Or you have a stop loss, it's the same. You have a trigger, and then when this trigger is reached, you sell or close the position at the best price, again depending on if you're long or short. But you just sell the contract or buy one contract, you just close your contract for difference. There are the option to have a trading stop loss or a stop loss that is trailed to the profit or of your position, or that at some specific point the stop loss is, for example, moved to break even. Those are all public practices. Now we visualize those orders a little bit, CFD pending orders. So you have a limit order. You have a stop order. So a limit order is we have a price point X and then price goes down. So we implemented a limit here or created an order with a limit price here. When the price gets there, we buy. In this case, we sell in this case. Or a stop order is we are below a specific price level, and when this price level is reached, then we buy. So this is like our price is not reached yet, but in the case of a buy, the price is above our price we want to buy. In the case of a stop buy or a buy stop, the price we want to buy is above the current price, but we say when the price reaches that level, then we want to buy. So most of the times we buy into the trend of the market, or we have as the third option, we have a stop limit. So we say the market needs to break through a specific price level. And when it broke the specific price level, then we place a limit order at that price level. Could also be a different price level. It does not need to be the same price level, but I hope you understand the logic. We break through a specific price level in the case of, or in the example of a buy. Of course, all those examples can be vice versa for sell. Buy limit is we buy below the price we are now. Stop. A buy stop is we buy the higher price. When we reach a specific price level, we buy into the market, and a stop limit buy is we reach a specific market point, and then after this trigger happened, then we place a limit. Same for sell. We sell above the current price. We have a sell limit. We have a sell stop. So we sell at a price below the current price level where we place the order, and then we sell the market. And we have the same with a sell stop limit. So we have a trigger of a price level that needs to be reached, and after that, automatically there's placed a limit order. Now, what is important for, or what is the checklist for choosing a good CFD broker? Low spreads and commissions. Because you will pay them, you will need to earn them. Otherwise, the market's against you. You have a 50-50% of chance of winning and losing when you click buy and sell. But the percentage that is against you, like in the casino, the one green field in roulette or the zero, this is the spread and commission in trading. And those should be as low as possible, because the higher they are, the more likely it is that you will lose money. You can compare them on forexbenchmark.com. Secondly, it should be regulated with financial authorities. We named some different here depending on where you are. In Germany, for example, the financial authority is the BaFin, but there are different financial authorities in different countries, and you should choose one that you trust. Third, there should be a negative balance protection. There has not always been. In Europe now there is one. So I think 10 years ago, I think even 5 years ago, not 100% sure when it changed, but it was possible that you trade and that you go in debt. So the broker gives you automatically a loan because your position went hardly negative. And then the broker puts it out that you need to pay more money than you invest in the broker. So you send 1,000 euros to the broker and you lost 2,000 euros, and then you need to send to the broker another 1,000, then you're even. And that should be protected, that you're not going to get sued if, or you don't even have the possibility to lose more money than there is in your broker account. Then you should have segregated accounts. So the money of the broker is on a different bank and not the broker's bank. So even if the broker goes bust, you still get your money back because it is with another bank. And of course, the reviews, reputation and history. How good is the customer support? Are there payouts? How long does the broker exist, or is it a new one? You need to check this for yourself, check this for your area. And if everything on the checklist gets a tick, then you're good to go.